Welcome back. I'm so glad you could join us today for another deep dive, because right now, as you and I are just kind of going about our daily lives, the entire financial world is fundamentally rewiring itself.
It really is. I mean, it's a massive shift.
Right. And you see the headlines, the consensus is cheering for this elusive soft landing. We have equity markets hitting new all-time highs, inflation prints are coming in cooler, and on the surface, the macroeconomic picture looks like this absolute triumph of monetary policy.
Yeah, it looks flawless on paper.
Exactly, on paper. But if you look at the actual underlying plumbing of global money, the sheer mechanics of how capital moves, how it clears, and where the world's largest pools of capital are actually being stored, we're undergoing a tectonic shift. It's a massive structural overhaul happening entirely behind the scenes, and frankly, it's going to dictate the next decade of market returns.
It definitely is. And today's deep dive is dedicated entirely to looking beneath that surface noise. To do that, we're synthesizing three incredibly dense, highly consequential sources of intelligence. We're dissecting the International Monetary Fund's April 2024 Global Financial Stability Report to really understand the macro risk environment.
Which is heavy reading, by the way.
Oh, very heavy. And then we're layering in a fascinating August 2025 white paper from State Street Global Advisors that tracks the real-time asset allocation of public pension funds.
Right, the whales.
Exactly. And finally, we're integrating an inside look at how the absolute titans of Wall Street are adopting tokenized private credit. When you put these three seemingly disparate pieces together, a very clear, very complex picture emerges about the future of global liquidity.
Okay, let's unpack this, because we have an enormous amount of ground to cover for you today. Our RAID map tracks the flow of capital from the macro down to the micro.
Yeah.
We're going to explore the hidden fragilities lurking in what the IMF calls the last mile of disinflation. Then we'll dive into the explosion of the private credit market and why it honestly has regulators losing sleep.
Keeping them up at night, for sure.
Right. And then we'll examine how trillion-dollar asset managers are using blockchain architecture to completely rewire that credit market. Then we look at how the $7 trillion public pension fund industry is just completely rebalancing its portfolios in response to this new rate environment.
Which changes everything.
That changes everything. And finally, we will break down the systemic wildcards, from treasury market basis trades to cyber risks that could upend all of it.
And the reason we're mapping this out for you is simple. By the end of this deep dive, you will understand how the world's absolute largest pools of capital are repositioning themselves. Understanding these structural currents gives you a massive analytical advantage. You won't just be reacting to the daily tape, you will understand the foundational mechanics that are driving the volatility.
So let's dive right into the macro reality right now. If you read the executive summary of that IMF report, the mood is shockingly optimistic. I mean, global equities are up roughly 20%.
Yeah.
Corporate and sovereign borrowing spreads have narrowed notably across the board. The market has essentially priced in a flawless execution of the last mile of disinflation. The consensus is acting as if the central banks have achieved the impossible.
If we connect this to the bigger picture, we have to look at the historical precedent of that last mile.
Right.
Central banks have executed one of the sharpest, most aggressive hiking cycles in modern history. And getting headline inflation down from 8 or 9% to 4% is actually the easy part.
Because you just crush the most rate-sensitive sectors of the economy, right?
Exactly. You crush housing, you crush big ticket loans. But squeezing that remaining persistent sticky inflation down to the 2% target without fracturing the labor market or breaking the credit cycle, that is a massive policy challenge.
It's threading a needle while running a marathon.
That's a great way to put it. The market is currently pricing in resilient growth, perfectly compliant inflation, and an imminent cutting cycle. It is literally pricing in perfection.
And because it's pricing in perfection, market volatility has been compressed to multi-year lows. Asset classes are highly correlated. But the IMF points out that this lack of volatility is essentially just a mask over a heavily pressurized system.
Yeah, a very thin mask.
Because when everything is priced for a flawless soft landing, the system becomes hypersensitive to any deviation, like a hot CPI print, or a geopolitical supply chain shock, or an unexpected corporate default cycle.
Precisely. And the IMF explicitly highlights the pressure points where a deviation from that perfect scenario could trigger a systemic event.
Right. Let's talk about those danger zones.
The most glaring of those is commercial real estate. The report notes that globally, commercial real estate prices have dropped 12% in real terms over the past year.
12%. Let's ground that in reality for a second, because 12% globally is hundreds of billions of dollars in vanished equity.
It's massive.
And the sources point out that the U.S. and European office sectors are the real epicenter here. Now, we understand the secular shift, hybrid work structurally altered the demand curve for office space. But let's look at the actual mechanics of a commercial real estate deal that is blowing up right now. Let's walk through that.
Let's do that. So imagine an institutional investor bought a prime office tower in 2019.
Okay. Great time to buy right before the pandemic.
Exactly. They capitalized it with, say, 65% debt at a sub 3% interest rate. And they're assuming a certain trajectory of rental growth and maintaining a 95% occupancy rate.
Seems totally reasonable in 2019.
Completely reasonable. Now, fast forward to 2024. That 5-year loan is maturing. They hit a refinancing wall.
Right, and the environment has completely inverted.
Exactly. The occupancy is now hovering at maybe 60% because tenants downsize their footprints upon lease renewal.
Because nobody is coming into the office 5 days a week anymore.
Right, so the net operating income has plummeted. But the real killer here is the capitalization rate. Cap rates have expanded significantly because the risk-free rate is so much higher.
Treasury yields went up. So the building's yield has to go up, which means the price goes down.
That's the math. So the building's valuation has cratered by 30 or 40%. When the sponsor goes to refinance, the new debt is pricing at 7 or 8% instead of 3. And because the value of the asset has fallen, the lender is demanding a massive cash-in equity injection just to right-size the loan-to-value ratio.
They're saying, hey, your building isn't worth what it was, so you need to bring $50 million in cash to the table if you want this new loan.
Yes. And in many cases, the sponsor simply looks at the math, realizes their original equity is completely wiped out, and just hands the keys back to the lender.
Strategic default. Which brings us directly to the banking vulnerabilities. Because who is holding the bag on those commercial mortgages?
It's not the mega banks.
Right, it's the regional banking sector.
That is the critical transmission mechanism. The IMF report notes that globally, banks holding $33 trillion in assets.
Wait, 33 trillion?
33 trillion, which is roughly 19% of the entire global banking system. They have breached at least 3 of the IMF's 5 key risk indicators.
19% of the global banking system breaching multiple risk metrics. That is a staggering figure. Now, to be fair, the IMF is careful to note that the broader banking system is far more resilient than it was pre-2008.
Yes, the Tier 1 capital ratios are robust, and the liquidity coverage is generally strong.
But they highlight a severe bifurcation.
Yes, the acute pressure is highly concentrated. We're looking specifically at regional banks in the United States, which have massive exposure to these middle market CRE loans and specific banking cohorts in China.
Right.
For these institutions, you're seeing a dangerous combination of thinning capital buffers and rapidly deteriorating asset quality.
Let's pull on that thread with China for a moment, because their property market is undergoing a fundamental restructuring. The sources indicate that existing home prices, housing starts, and sales volumes have all sharply declined. And the structural design of the Chinese real estate market means this isn't isolated. It's heavily intertwined with their local government financing vehicles and the broader asset management industry. It is a localized deleveraging that acts as a massive deflationary anchor on global growth.
It does, and the global context of how debt is maturing is incredibly diverse right now. In advanced economies, you have a massive corporate debt wall approaching. Highly leveraged companies are facing the reality of refinancing their capital structures at rates they haven't seen in 2 decades.
Yeah.
But fascinatingly, major emerging markets have shown remarkable resilience.
Which is counterintuitive, right? Usually they're the first to break.
Exactly. But they didn't have the luxury of zero interest rate policies during the 2010s. So they hiked early, they hiked aggressively, and their macroeconomic frameworks have largely absorbed the shock.
But the IMF draws a sharp distinction between major emerging markets and frontier economies. They highlight a really insidious dynamic in these smaller developing nations. They call it the sovereign bank nexus. Can you break down exactly how that loop functions?
Of course. So in a frontier economy, when global financial conditions tighten, international capital markets often just close their doors to them. They simply cannot issue dollar-denominated debt because the yields demanded by international investors are entirely punitive.
They can't afford to borrow globally.
Right. But the sovereign government still has to fund its deficit. So they turn inward, they heavily incentivize, or frankly strong-arm, their domestic banking sector into buying the newly issued government bonds.
This creates a terrifying feedback loop.
Exactly. You end up with a domestic banking system where the balance sheets are overwhelmingly concentrated in the debt of their own sovereign government.
Wow. So they're tethered to each other.
Completely. If the sovereign experiences a fiscal shock or currency crisis, the value of those bonds plummets, which immediately impairs the capital of the domestic banks. This cuts off lending to the private sector, which crashes the real economy, which then further destroys the sovereign's tax revenue.
It's a closed-loop doom spiral.
It really is.
So what does this all mean? Let's synthesize this macro reality for you listening right now. The system looks calm on the surface, but the underlying architecture is straining. You have commercial real estate repricing violently, 90% of the global banking system flashing warning signs, and complex debt dynamics across emerging markets.
Yeah.
And it's exactly this tightening of traditional bank lending, this pressure on the regional banks, that has accelerated the most significant shift in modern finance. Because the demand for capital didn't evaporate when the banks pulled back, it just migrated.
It migrated out of the highly regulated, heavily scrutinized public banking sector and straight into the private markets. This is the explosion of private credit.
Let's really dig into this because private credit has morphed from this niche, high-yield alternative into a multi-trillion-dollar shadow giant.
Yeah, the growth is astronomical.
Following the global financial crisis, regulators basically told traditional banks that holding heavily leveraged, risky corporate loans required prohibitive amounts of capital.
Right, the new Basel rules made it very expensive for them.
So the banks stepped back. And into that void stepped asset managers, private equity firms, and dedicated non-bank lenders.
To frame the scale here, private credit is no longer just providing, mezzanine financing for small, distressed buyouts. These funds are now writing single checks for billions of dollars.
Billions.
Yes. They are competing directly with the syndicated loan market and public high-yield bond markets. They are funding massive leveraged buyouts, infrastructure projects, corporate expansions. But the IMF dedicates a huge portion of its stability report to the macro-financial risks compounding within this exact space.
And the fundamental issue the IMF points to is that we are flying blind. The opacity is a feature, not a bug, for these funds. But let's look at the actual structural vulnerabilities they identified, starting with the borrowers themselves.
The borrower profile in private credit is inherently distinct from the public markets. These are typically middle market companies. They are often highly concentrated in the technology and healthcare sectors. And crucially, they carry significantly more leverage relative to their earnings than companies issuing public high-yield debt.
And here's where the math becomes absolutely brutal in our current environment. The vast majority of private credit is issued as floating rate debt.
Yep, floating rate.
So when the central banks aggressively hiked rates by 500 basis points, the interest burden on these highly leveraged mid-cap companies didn't gradually increase as they refinanced in the future. It skyrocketed instantaneously.
Which brings us to one of the most alarming data points in the entire IMF report. As of the third quarter of 2023, roughly 1/3 of small firms in advanced economies and more than half of small firms in emerging markets had a cash-to-interest expense ratio below 1.
Let's stop and really emphasize what that means mechanically for you listening. A ratio below 1 means that the actual free cash flow generated by the operating business is literally insufficient to cover the interest payments on their debt.
They are bleeding.
They are burning cash just to service the loan. If you are a mid-cap software company that was taken private in 2021 with a massive floating rate loan and your debt service has doubled, you are fundamentally insolvent on a cash flow basis unless you can aggressively cut costs or your private equity sponsor injects more equity.
And that dynamic leads directly to the next vulnerability: stale and subjective valuation.
Oh, this is the wild part.
It is. In the public equity or public high-yield markets, price discovery happens every single second. If a company's cash flows deteriorate, the market prices their debt at 80 cents on the dollar, then 60 cents. The pain is transparent and it's immediate.
But in private credit, who decides what the loan is worth? The exact same fund that issued the loan.
Exactly. They use internal models to mark the value of the asset, and there is an enormous structural incentive to utilize what the industry calls extend and pretend.
Extend and pretend.
Right. If a borrower breaches a covenant or can't make an interest payment, rather than marking the loan down and taking a hit on their returns, the private credit fund might restructure the loan. They might roll the interest into the principal, what we call payment in kind, or PIK interest.
So they just say, don't pay us cash now, just owe us more money later.
Yes. This keeps the loan marked at par on the fund's balance sheet, completely masking the underlying deterioration of the asset quality.
But wait, let me play devil's advocate and push back on this. Because these private credit funds are managed by some of the most sophisticated financial minds in the world, they know the reality of their portfolios. If the valuations are subjective and they're potentially hiding losses, how does that actually threaten the broader system? Doesn't the pain just stay locked up between the fund and its institutional limited partners?
That is the assumption that worries the IMF the most. The belief that private credit is a closed ecosystem is an illusion. The interconnectedness is staggering. First, consider the leverage. The private credit funds themselves often utilize subscription lines of credit or asset-backed leverage facilities provided by traditional, systemically important banks. So the banks still have the exposure, it's just indirect now.
So the banks are lending to the funds who are lending to the fragile companies.
Precisely. And furthermore, look at the liability side of these funds. To maintain this exponential growth, private credit funds have aggressively expanded their investor base. Historically, this was lockup capital. You commit your money for 7 to 10 years and you can't touch it.
Right.
But recently, to attract high net worth individuals and a broader array of institutions, they've popularized semi-liquid structures. These structures offer periodic redemption windows, allowing investors to pull their capital out monthly or quarterly.
But that creates a massive liquidity mismatch. You are offering semi-liquid redemptions on an underlying asset middle market corporate loans that is fundamentally illiquid.
Yes.
If macroeconomic panic sets in and a flood of investors submit redemption requests at the exact same time, the fund can't instantly liquidate those loans to pay them out.
Yeah.
You can't just sell half of a private software company loan on a Tuesday afternoon.
Exactly. They would be forced to impose gates-halting redemptions entirely, or they would have to sell their highest quality, most liquid assets into a distressed market, which just accelerates the downward pricing spiral. The IMF's concern is that because of the opacity, the embedded leverage, and the interconnectedness with traditional banks and pension funds, a sharp downturn in the credit cycle could turn private credit into a systemic black box.
Nobody knows who holds the ultimate risk until the margin calls start.
That's the fear.
It is a phenomenal juxtaposition.
Yeah.
You have this vital, multi-trillion-dollar engine of economic growth that is structurally riddled with opacity, subjective valuations, and liquidity mismatches. But the demand for the high yields it generates is insatiable. So the market isn't going to shrink. It has to evolve.
It has to.
Here's where it gets really interesting. Because the Wall Street titans aren't waiting for regulators to fix the plumbing of private markets. They are rebuilding the pipes themselves. Let's look at the technology fix, the aggressive move into tokenization.
And it is absolutely critical to frame this correctly. When we discuss tokenization in this context, we are entirely divorcing the conversation from the speculative crypto trading of the past decade.
Right, we're not talking about meme coins here.
Not at all. We are analyzing how trillion-dollar legacy institutions, firms like BlackRock, Franklin Templeton, Hamilton Lane, WisdomTree, how they are adopting distributed ledger technology as the new foundational architecture for capital markets.
They are taking the messy, operationally heavy, opaque world of private credit and turning it into programmable, transparent, instantly transferable digital assets on a blockchain.
Yes, it's infrastructure, not speculation.
Let's analyze the actual mechanics of what these players are doing, starting with Franklin Templeton, because the sources identify them as the early architect. They didn't just create a digital representation of an asset, they tokenized the entire shareholder record for a U.S. government money market fund. Walk us through why that is a structural paradigm shift compared to traditional finance.
To appreciate the shift, you have to understand the legacy system. In a traditional mutual fund, when you buy a share, there is a massive administrative back office process. You have the broker, the clearinghouse, the custodian, and crucially, the transfer agent.
The transfer agent?
Yes. Their sole job is to maintain the database of who owns what, which requires constant, batch-processed reconciliation between multiple disparate ledgers. This is why traditional settlement takes a day or two, and it's incredibly labor-intensive.
Franklin Templeton, essentially deleted the transfer agent's database and replaced it with a smart contract.
Exactly. Their proprietary system, utilizing the BNJ token, runs the official, legally recognized share registry directly on a public blockchain.
Wow.
The token is the record of ownership. When a transaction occurs, settlement is atomic. The exchange of value and the update of the ownership record happens simultaneously and instantly. There is no T+1 settlement. There is no reconciliation process.
That's huge.
And the compliance rules, like who is legally allowed to hold the asset, are programmed directly into the token's smart contract. If an unverified wallet tries to receive the token, the transaction simply fails at the protocol level.
It strips out layers of intermediary friction. And then you look at BlackRock. The source explicitly states that when BlackRock moves, it's a signal, not a trend. They view tokenization as the next evolutionary leap in asset management, drawing a direct parallel to the creation of the ETF in the late 90s.
Yes.
BlackRock isn't just looking for operational efficiency. They're looking to unlock massive new distribution channels and create entirely new forms of collateral.
That collateral aspect is vital. If you tokenize a money market fund or eventually a private credit fund, you create a highly secure, yield-bearing asset that can be instantly transferred 24/7.
Right, because blockchains don't close on weekends.
Exactly. Institutional players can use these tokens as instant collateral for derivative trades or repo funding, operating entirely outside the traditional banking hours and settlement windows. It fundamentally increases the velocity of capital.
And then you have Hamilton Lane, one of the giants of the private markets. Their strategy directly addresses the accessibility problem. Historically, allocating to a premier private credit fund required a massive institutional check fit, tens of millions of dollars, and the administrative burden of handling capital calls and distributions was immense. Hamilton Lane is utilizing tokenized feeder funds to drastically lower those minimums.
They are democratizing access. They're allowing high net worth individuals and smaller family offices to access institutional quality private credit. By tokenizing the fund, the fractionalization becomes infinitely scalable.
Because the code handles the math.
Right. The smart contract automatically executes the capital calls and distributes the yield proportionately without requiring an army of accountants to process the paperwork.
And finally, WisdomTree, whose thesis is perhaps the most absolute. Their CEO has explicitly stated the belief that every financial asset will eventually be tokenized. They aren't just launching individual funds. They are building a comprehensive, unified digital asset platform. They envision a consolidated ledger that natively integrates digital identity, regulatory compliance, and cross-asset settlement.
It's a grand vision.
It is. But let me stop and play devil's advocate here again. We just spent the entire last segment discussing the IMF's terror over private credit. The IMF said the assets are fundamentally illiquid, and the funds are hiding behind semi-liquid structures. If Hamilton Lane and BlackRock successfully tokenize these private credit loans, making them instantly tradable 24/7 on a blockchain, doesn't that make the systemic risk worse?
How so?
Aren't you just building a high-speed, frictionless rail network for an instantaneous bank run the second the market panics?
That is the exact tension regulators are grappling with, and it's a brilliant question. The tokenization of an illiquid asset does not magically make the underlying asset liquid.
Right.
If a mid-cap software company defaults on its loan, the token representing that loan is still impaired. However, what's fascinating here is that the proponents of tokenization argue that it actually neutralizes the specific risks the IMF is worried about. Think about the opacity and the stale valuations.
No way.
On a tokenized network, every transaction, every collateral movement, every yield distribution is recorded on a transparent, immutable ledger.
So the regulators and the investors could theoretically see this stress in real time.
Exactly. You replace subjective quarterly valuation models with continuous market-driven price discovery. Furthermore, regarding the bank run scenario, smart contracts allow funds to enforce redemption gates or liquidity limits algorithmically, with absolute precision and transparency.
So instead of a board meeting in a panic, the code just says, nope, liquidity limit reached.
Yes. It replaces discretionary board decisions in the middle of a crisis with hard-coded logic. It forces an operationally heavy, dark market into a framework of transparent data and instant cryptographic settlement.
And the momentum behind this infrastructure build-out is massive. We cannot ignore the broader digital asset context that the IMF report highlights. We are seeing Bitcoin prices structurally holding near all-time highs, total crypto market capitalization approaching $3 trillion, and the wildly successful integration of spot Bitcoin ETFs into traditional brokerages.
It's mainstream now.
Right. The institutional adoption of digital assets as a macro hedge has essentially provided the regulatory and technological cover for Wall Street to aggressively build out this tokenized plumbing for traditional finance.
It's the Trojan horse for the technology.
Totally. So we've established the macro fragility, we've established the explosion of private credit, and we have explored the high-tech blockchain architecture being built to modernize it. But none of this matters without the buyers. Who is actually deploying the capital to purchase these assets?
That's the key question.
That brings us to the whales. Let's shift our focus to the State Street 2025 white paper analyzing the behavior of public pension funds. We are talking about $7 trillion in assets under management. These institutions control roughly 5% of the entire global market portfolio. When they shift their asset allocation by even 1%, it moves global markets.
They are the ultimate long-term structural buyers in the global economy. And what State Street has documented is a profound generational reversal in their investment strategy. To understand this, you have to look at how pension funds operate through asset liability management, or ALM.
Let's break that down because the math dictates their behavior.
Right. A public pension fund has a strictly defined liability. They must pay out a specific amount of money to retirees every month, stretching decades into the future. To ensure they can meet those liabilities, actuaries calculate a required rate of return, a hurdle rate.
Like an absolute minimum they have to earn.
Exactly. But for the entire decade following the 2008 financial crisis, central banks anchored risk-free interest rates at 0.
So a pension fund looking to buy a safe 10-year U.S. Treasury was getting maybe 1.5%. But their actuaries were telling them they needed a 7% annualized return just to remain solvent.
Exactly. The zero interest rate policy explicitly forced the most conservative pools of capital in the world to march further and further out on the risk spectrum.
They had no choice.
None. They had to systematically underallocate to save government bonds and aggressively buy public equities. And when public equities weren't enough, they poured trillions of dollars into illiquid alternative investments, private equity, venture capital, and private credit, simply to chase the yield required to hit their hurdle rate.
But the State Street paper declares that era is over. We are in a higher for longer rate environment, and the structural mandate has shifted. The data is definitive. Bonds are back.
They are back in a big way.
Because the risk-free rate is fundamentally higher, pension funds can finally generate a massive portion of their required return without taking on equity risk or locking their capital up in illiquid 10-year funds.
The numbers validate this entirely. Sovereign fixed income allocations, so their holdings of government bonds, grew from 29% of total portfolios in 2021 to 32% by 2024.
That's a massive move.
That 3% shift represents hundreds of billions of dollars rotating out of risk assets and into sovereign debt.
And the State Street data highlights fascinating regional nuances in how they're capturing this yield. Asian public pension funds are aggressively diversifying, moving capital away from their domestic bonds and hunting for yield in foreign government debt. Meanwhile, European pension funds are showing strong conviction in high yield and emerging market debt. They're utilizing their massive balance sheets to act as liquidity providers in these higher yielding fixed income sectors.
But the most consequential revelation in the State Street data, the data point that should make every equity and private market investor pause, is what is happening to their alternative allocation.
Yes, this is huge.
For years, the financial narrative has been that institutional capital will perpetually flow into private markets. But the data shows that public pension fund allocation to alternatives has essentially plateaued. It has leveled off at approximately 23% of their total portfolios.
Let's analyze why that plateau is happening, because it connects perfectly to our earlier discussion on private credit. It all comes back to the math of the discount rate. If a pension fund can buy a liquid, AAA-rated government or corporate bond and lock in a safe 5 or 6% yield, the opportunity cost of investing in alternatives changes dramatically.
It absolutely does. If the risk-free rate is 5%, the illiquidity premium demanded by a pension fund to lock their money up for 10 years in a private equity fund is suddenly 9, 10, or 11% net of fees.
Right, it's too high a bar.
And as we discussed, those private funds rely heavily on leverage to generate those returns. With borrowing costs structurally higher, the private funds are struggling to hit those elevated hurdle rates.
Not to mention the denominator effect.
No, exactly, the denominator effect.
Which is, when public equity and bond portfolios drew down heavily in 2022, The relative percentage of a pensions portfolio allocated to private markets mechanically spiked.
Because the private markets hadn't marked down their assets yet.
Exactly. It pushed them above their strict mandated limits. They physically couldn't allocate more to alternatives even if they wanted to.
And crucially, these funds have demographic realities. The baby boomer generation is retiring. The pension funds have strict, non-negotiable timelines for cash outflows. They are acutely aware of the liquidity mismatches we discussed earlier.
They need cash on hand.
Yes, they simply cannot afford the liquidity risk of having excessive capital trapped in opaque private credit or private equity vehicles when they have guaranteed monthly payouts to make to retirees.
However, even within that plateaued 23% alternative allocation, a massive internal cannibalization is occurring. The State Street paper notes that private equity and private credit combined have surged to 10.1% of the total portfolio, up from just 5.1% a decade ago. It has officially dethroned real estate, which sits at 6.4% as a primary alternative asset class.
Which perfectly reflects the commercial real estate devastation we discussed in segment 1. They are running from the office sector and funneling whatever alternative allocation they have left into private credit.
But we have to bring this back to you, the listener. How does the behavior of a sovereign wealth fund or a state pension affect your personal portfolio?
This raises an important question. For a decade, public pension funds provided a relentless, price-agnostic bid for global equities and private markets because they had no alternative.
They were just buying everything.
If a $7 trillion industry is now structurally capping its exposure to risk assets and redirecting its new capital inflows back into fixed income and government bonds, that removes a massive foundational pillar of support for stock multiples.
Right.
It is a persistent macroeconomic headwind. The supply and demand dynamics for risk assets have fundamentally shifted.
It is the tectonic plates of global finance realigning. The pension funds are buying the bonds, Wall Street is tokenizing the private debt, and the traditional banks are just trying to survive the commercial real estate fallout.
It's all connected.
Which brings us to our final act today. We need to synthesize everything we've discussed by examining the systemic wildcards. The IMF report highlights two acute vulnerabilities that sit at the absolute intersection of all these shifting capital flows. First, the restructuring of the government debt market, which has established that pension funds are buying more government bonds.
Yeah.
But the scale of sovereign debt issuance is astronomical, and the traditional buyers are stepping away.
The shift in the buyer base for sovereign debt is one of the most under-discussed risks in the market today. During the pandemic, the central banks were the buyers of first and last resort. Through quantitative easing, they absorbed trillions of dollars of government issuance. But that era is over.
They're long gone.
The Federal Reserve is actively shedding roughly $780 billion of assets annually through quantitative tightening. The European Central Bank and the Bank of England are doing the exact same thing.
So the central banks are dumping bonds, and governments are running massive fiscal deficits, issuing just a tsunami of new debt. The pension funds are buying, but they aren't enough to absorb the supply. So who's clearing the market? The IMF points out that increasingly the marginal buyers of U.S. Treasuries are hedge funds, and they aren't buying them for yield. They're buying them to execute highly leveraged arbitrage strategies, specifically the Treasury basis trade.
Let's demystify the Treasury basis trade, because understanding this mechanic is crucial to understanding bond market volatility.
Walk us through it.
The Treasury basis trade is a classic relative value arbitrage. A hedge fund spots a tiny microscopic price discrepancy between a cash U.S. Treasury bond and the corresponding Treasury futures contract. Perhaps the cash bond is trading slightly cheaper than the implied price of the futures contract.
And when we say tiny, the discrepancy is often fractions of a penny.
Exactly, fractions of a cent.
Yeah.
So to make the trade profitable, the hedge fund buys the cash bond and short sells the futures contract, locking in that tiny spread. But because the margin is so small, they have to apply massive amounts of leverage.
They borrow to scale it up.
Yes. They take the Treasury bond they just bought, pledge it as collateral in the repo market, borrow cash, and do the trade again. They might lever the position 50 or 80 times over.
And this is where the systemic fragility kicks in. The IMF highlights that because hedge funds are utilizing extreme leverage, they are intensely sensitive to margin requirements and price volatility. If a macroeconomic shock hits, say, a surprise inflation print or a sudden geopolitical escalation, volatility in the Treasury market spikes.
And when volatility spikes, the clearinghouses and the repo lenders immediately demand higher margins. They demand larger haircuts on the collateral. Suddenly, the hedge fund has to post massive amounts of cash just to maintain the position.
And if they don't have the cash?
If they don't have the cash, they are forced to rapidly unwind the trade, selling the underlying treasury bonds into an already panicked market.
Which accelerates the price crash, triggering more margin calls for other funds. This isn't theoretical, by the way. This is exactly what caused the treasury market to fundamentally break down in March of 2020 during the dash for cash. It forced the Federal Reserve to intervene with trillions of dollars just to restore liquidity to the risk-free asset class. The IMF is warning that because hedge funds are once again the marginal buyers of government debt, the foundation of the global financial system is highly reactive and volatile.
And that reliance on clearinghouses and interconnected market plumbing leads us to the final, profoundly modern wildcard the IMF identifies: cyber risk.
Yeah, this is a big.
We have spent an hour discussing the intricate, digitized movement of trillions of dollars across complex ledgers. The financial sector is the most heavily targeted industry in the world for cyber attacks because of its immense concentration of sensitive data and absolute reliance on technological interconnectivity.
The IMF draws a critical distinction here, though. They note that the day-to-day cyber losses, credit card fraud, isolated ransomware attacks on small vendors, those are relatively modest and absorbed as a cost of doing business. But the probability of extreme losses, a systemic cyber event, is rising exponentially.
It's the tail risk.
Right. Let's think about this in the context of our tokenization segment. The legacy system relies on centralized clearinghouses like the DTCC to settle trades. The future system being built by BlackRock and Franklin Templeton relies on distributed ledgers and smart contracts. What happens if the core infrastructure is compromised?
A successful, sophisticated cyber attack on a central counterparty clearinghouse or a zero-day exploit in the foundational smart contract of a massive tokenized private credit network would not just be a data breach, it would be a catastrophic liquidity event.
Because no one can trade.
Exactly. If the ledger is frozen or if atomic settlement fails, market participants instantly lose confidence in who owns what. Margin cannot be calculated, collateral cannot be moved. The interconnectedness of the system means that a failure at a critical node cascades globally in milliseconds.
It's terrifying.
The IMF is explicitly warning that the next systemic financial crisis might not be triggered by a credit default cycle, but by a catastrophic disruption to the digital infrastructure that allows the market to clear.
It's the ultimate wildcard in a hypersensitive system. So let's pull all of these threads together. You have just looked deep under the hood of the global macroeconomic engine. You now understand that the widely celebrated soft landing is precariously balanced on top of hidden fragilities in commercial real estate and the regional banking sector.
You understand the mechanics of the shadow banking system, where multi-trillion-dollar private credit funds are navigating fragile borrowers and dangerous liquidity mismatches.
You see exactly why the titans of Wall Street are racing to build a tokenized blockchain architecture, not to participate in crypto speculation, but to force transparency, instant settlement, and operational efficiency onto these massive, opaque asset classes.
And you know how the ultimate whales of finance, the $7 trillion public pension funds, are fundamentally shifting their behavior, capping their exposure to illiquid private markets, and redirecting capital back to government bonds, while hedge funds play highly leveraged arbitrage games with the very same debt.
This is what it means to move from a reactive posture to a strategic, informed understanding of the financial landscape. Knowledge of these structural currents is only valuable when it's applied.
Absolutely. The next time you see a headline about a central bank rate decision, you won't just think about the yield on a savings account. You will understand how that decision instantly alters the cash-to-interest ratio of a highly leveraged private credit fund.
Right. You will understand how it forces a sovereign wealth fund to adjust its discount rate and pull capital from public equities. You can parse the surface-level noise and see the underlying matrix of capital flows.
And as we wrap up, I want to leave you with one final provocative concept to mull over. We have spent a significant portion of this deep dive exploring the boom in private credit and the aggressive push by institutions like WisdomTree to tokenize it. Their explicitly stated goal is that eventually, every financial asset will exist on a unified digital ledger.
Everything.
Everything. So I want you to think about the logical conclusion of that architecture. If that actually happens, if every bespoke private loan, every fractional share of a commercial office building, and every unit of an illiquid private equity fund becomes a transparent, highly liquid, instantly tradable token on a global blockchain, does the very concept of a private market fundamentally cease to exist?
That's a profound thought. The defining characteristic of private markets has always been the illiquidity premium and the opacity. If you strip that away, if everything everywhere can be analyzed and traded by anyone 24/7, does the entire global economy just become one giant, hyper-correlated, hyper-volatile public stock market? And if we successfully engineer a future with no illiquidity and absolute price discovery on every asset, where do the $7 trillion pension funds hide to find stability when the next true crisis hits?
Something to think about.
Thank you so much for joining us on this deep dive into the plumbing of the global economy. Stay curious, keep critically examining the narratives, and we will see you next time.